Okay, real estate investors, case study number 3. Last 2 case studies were pretty deep, depending on how deep you'd like to go. So here we're going to look at a smaller funding scenario, still a 35-year-old male, only we're going to look at funding a policy at $10,000 per year for 15 years. Very simple in this respect. So we have a total of $150,000 going into the policy. And for the property purchase, we're going to look at 2 purchases. One, $20,000 coming out in policy year 3, and then $100,000 coming out in year 15. Can easily borrow and repay more frequently than that, but just 2 simple loans here. So here we go. Quick side note, because I do like to touch on this, it's important, depending on anyone's situation, that $10,000. Am I locked into that every single year for 15 years? No. I can stop paying much earlier than that. I can go longer than 15 years. What I'll add though is that the premium piece is just over $1,000. So he has close to a minimal commitment with the ability to add more funds at his discretion. So he's not locked into a $10,000. You know, everyone's situation is different. If I look at a $10,000 per year payment and that is intimidating, I like the ability to pay that, but it's like, I don't know if I can stretch that. Well, if I have a policy where I can easily commit to, call it $100 a month or $150 a month, and then add more up to 10,000, really loosens the vice grips and enhances, call it, my comfort level. Say, okay, I can actually do this now because I'm not committed or obligated to make this payment. So how do I do that where I can actually use the policy and have peace of mind, not be locked into a bill? So as always, we like to compare the growth. Here we go. So I'm a real estate investor. My year 3, I paid in $30,000, got $27,000, almost $28,000. I borrow out $20,000. What's the impact of that policy loan? So I know that dividends are going to be paid, any money in cash value, and my outstanding loan balance. Meaning, even though I pulled out $20,000, I'm still going to receive dividends on that full $27,728 as if I never touched it in the first place. No lost opportunity cost. How the insurance company does that. 1, there is a loan interest expense. Have to account for that. Here we go. There's the expense, 5%. In this case, directly to the insurance company. We're assuming we cover it out of pocket each year. Loan interest payment, $1,000 per year. That's all we pay every year. Well, I shouldn't say all we pay, in addition to the $10,000. So my true net out of pocket beginning year 4 is $11K in this example. Is that required? No. Here we illustrated it. If you have the means to pay loan interest, makes sense. Would recommend doing it every single time. Would also refer you to our video around the topic of, does it make sense to take cash flow and pay it into PUAs or pay off my loan? What you'll find in that study, if you haven't seen it already, is it almost always makes sense to pay the loans and the loan interest off first. Now, granted, everyone's situation is different. If I'm saying, let me just plow money into PUAs because I'm going to pay the loan off, I've got a plan for that. Hey, that's good. That's perfectly fine. But just building awareness around the dollar and the actual net internal rate of return, the interest, how my money's staying at work for me, what's the most efficient? Efficiency, man, that's what I love. I'm getting too excited. So we've got the $10,000 per year going in for 15 years. There's the $20K loan. Here's the $100K loan. Borrow it out. Total balance is now $120. Again, let's look at this. Cash value, $72,937. Over here, $198. Main thing, death benefit. Without any loans, death benefit's $873. With loans, $120,000, $753. $873 minus $120 gives me $753. So there's the answer to the question, what happens if I die with a loan outstanding? Well, the death benefit, the net death benefit, is whatever the original death benefit was minus the loan balance. That's what's reflected on this example. It's also what is reflected on the illustration directly from the insurance carrier. There we go. Assuming we pay loan interest out of pocket forever in this example. Let's look at the repayment example here. Two of them we're going to look at. Same example with the growth, $20,000. That's the loan. You'll notice a ton of consistency here. All we did was pull all of these values directly from the illustrations and put them in Excel. One, so we don't disclose the company information. That's on our membership program. But then two, way easier. If you ever looked at an insurance illustration with loans, this would be one page with a million different columns, which we walk through explaining each and every single one of them, but it's a lot of data. Here we just see the numbers. So I pull out the $20,000 loan. There's my loan balance. Here, I'm assuming I pay the loan interest out of pocket and then apply $3,000 per year towards the balance. It is paid off in this example at year 10. At that point in time, my cash value and death benefit is 100% restored to exactly what it would have been as if I never touched it in the first place. So I keep on cranking. That's why so many real estate investors are attracted to this. They know it goes nowhere but up. That often they can do the exact same thing with real estate they own if they're buying property with property they own. The only difference there really is real estate fluctuation, goes up and down. And if I'm leveraging real estate, typically I've got to go through a bit more of a process to get a loan or mortgage or line of credit from a bank. We know how that works. Next loan, $100,000. So now I've built the values up over time. This is a great example for someone starting. $100,000 loan, collateralized death benefit, cash value, think of it this way, is the available equity I can access, just like equity against a property. Come on, Steve, gotta keep that clean there. There we go. There's the collateral, dollar for dollar. Repaid, so there's my loan interest, $5,000 the first year. We repaid $5,000 in loan interest plus $10,000 towards the principal. So what I did here specifically, I did this deliberately, was started the heavier payment, so $10K per year, after we funded the policy for 15 years. So you'll notice there's no more out of pocket here. We stopped paying and directed the principal payments toward the loan balance. I'm also covering the loan interest. The anticipation is I still have the $10K of cash flow and I'm producing income from the real estate. Maybe it's much more than this. I can pay it off faster. This is really meant to demonstrate the impact of the policy here. Fully restored when I pay it back. There we go. So we see everything fully restored in this example, death benefit and cash value. So really the purpose of this example was to demonstrate just $10,000 per year going into a policy. We don't need a ton of money. The last example showed $50,000 per year. The next couple case studies are going to demonstrate much higher numbers for individuals who are a bit older. Again, the numbers, I've mentioned this several times in the past, don't really matter to a degree as long as the ratios are comparable. Meaning when I'm designing a policy, I want consistent ratios, low premiums, maximum PUAs, setting the MEC limit where I want so I can then optimize a policy, have as much capital as possible, and then start moving forward with the real estate. So as always, I hope that you enjoyed this, and I do hope that was helpful. Feel free to reach out with any questions at all, and we'll talk to you soon. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.